Investing for Beginners, a comprehensive guide to getting started. Investing can seem very complex and confusing when you're just starting out. However, with the right information and strategies, investing can be a powerful tool to achieve your financial goals. This guide covers everything from the basic concepts every beginner investor should know, to the various investment options available, and the practical steps to start investing. Through this guide, you'll gain a better understanding of the world of investing, and develop the ability to plan your financial future. 1. Understanding the basics of investing. What is investing? Simply put, investing is the act of purchasing assets or allocating capital, with the expectation that these assets will generate income or increase in value over time. The goal of investing is to grow your current assets into larger assets in the future. However, this process involves risk, and the value of your investment assets may decline, contrary to your expectations. Why is investing important? Simply saving money is not enough to combat inflation. Inflation reduces the purchasing power of money over time, which means that the real value of money saved in a bank decreases. On the other hand, by investing, you can grow your assets to offset and even outpace inflation. Additionally, investing is essential for achieving long-term financial goals. For example, to reach significant financial goals like retirement savings, purchasing a home, or funding your children's education, saving alone may not be sufficient. Investing provides an opportunity to grow your assets to meet these goals. Key concepts in investing: risk and return balance. All investments involve risk, and this is closely related to potential returns. Generally, investments that offer higher returns come with higher risks. For example, stocks can offer high returns in the long term, but they can also experience significant short-term volatility. In contrast, bonds are relatively stable but may offer lower returns. Compound interest. Compound interest is one of the most important principles in growing your assets. It refers to the process where interest is earned not only on the original principal, but also on the interest that has already been added. Over time, the effect of compound interest can significantly increase the value of your assets. This is one of the key reasons why it's important to start investing as early as possible. Diversification. By diversifying your investments across different assets, you can reduce risk. This means that the decline in value of one asset will have a minimal impact on your overall portfolio. Diversifying across different asset classes can help cushion the impact of economic changes. 2. Exploring investment options. Stocks. Stocks represent ownership in a company. When you own stocks, you own a part of that company, and you may receive dividends based on the company's profits, and your asset value can increase as the stock price rises. Stock investing offers high growth potential, but also comes with significant risk due to market volatility. The stock market is heavily influenced by economic conditions, corporate performance, and global events, so careful analysis and a long-term perspective are essential. Bonds. Bonds are debt securities issued by governments or corporations to raise funds. Bondholders receive periodic interest payments and get their principal back when the bond matures. Bonds are generally more stable than stocks and offer predictable returns. However, the value of bonds can decrease if interest rates rise, making them sensitive to economic conditions. In particular, during periods of rising interest rates, the prices of existing bonds tend to fall. ETFs and mutual funds. Exchange-traded funds. ETFs and mutual funds are investment options that pull together a variety of stocks or bonds into a single investment product. ETFs typically track a specific index e.g., S&P 500, and investors can trade them just like individual stocks. Mutual funds are managed by professionals who oversee the investment portfolio, and investors receive a share of the profits based on the fund's performance. These funds are effective in reducing risk through diversification, especially for beginner investors who may find it challenging to select individual stocks or bonds. Real estate. Real estate involves physical assets such as residential properties, commercial buildings, and land. Real estate investment can offer stable returns and long-term asset appreciation, but it requires substantial initial capital and ongoing management and maintenance. The real estate market is heavily influenced by local economic conditions, interest rates, and government policies, so effective analysis and forecasting skills are crucial. Alternative investments. Alternative investments include assets like gold, silver, artwork, and cryptocurrencies, which differ from traditional stocks and bonds. These assets can be used to diversify a portfolio and may retain or even increase in value during specific economic conditions. However, they can also be highly volatile. For example, cryptocurrencies can experience sharp price swings, offering the potential for high returns, but requiring investors to accept a high level of risk. 3. Getting started with investing. Step 1. Assess your financial situation. Before you start investing, it's important to assess your current financial situation. Prioritize building an emergency fund and paying off high-interest debt. This will help you manage the risks associated with investing. Additionally, accurately track your monthly income and expenses to determine how much you can allocate for investing. Avoid overextending yourself, as this can lead to financial stress. It's crucial to create an investment plan that suits your financial circumstances. Step 2. Set your goals. Clearly define why you are investing and what your goals are. Specific goals like saving for retirement, buying a home, or funding Your children's education will help you develop a tailored investment strategy. The timeframe of your goals will also influence your investment strategy. For instance, short-term goals 13 years may require safer investments, while long-term goals 10 years or more can tolerate higher risk and potential returns. Step 3. Open an investment account. To start investing, you need to open an investment account. Most people open accounts with online brokerage firms, where they can trade stocks, bonds, ETFs, and more. When choosing a brokerage, compare various fee structures and account maintenance requirements to find the one that best suits your needs. Additionally, using a robo-advisor can automate investment strategy, development and portfolio management. Step 4. Develop an investment strategy. Create an investment strategy that aligns with your goals and risk tolerance. For long-term goals, focus on growth assets like stocks, while for short-term goals, consider safer assets like bonds or savings accounts. Determine your asset allocation based on your investment style: aggressive, conservative, neutral, and include risk management strategies to prepare for market volatility. Step 5. Continuously learn and manage. The investment world is constantly changing. Economic news, corporate earnings reports, and changes in government policies can all have a significant impact on investments. Therefore, it's important to continuously educate yourself and regularly review your portfolio. Adjust your portfolio as needed, based on market conditions, and explore new investment opportunities. If necessary, seek advice from experts. 4. Common mistakes beginners should avoid. Overreacting to short-term market movements. The stock market can be volatile, but it tends to rise over the long term. Reacting too quickly to short-term fluctuations by frequently trading can reduce your overall returns. It's important to maintain an objective and long-term perspective, rather than making decisions based on emotions. Taking on excessive risk. A common mistake among beginners is overestimating their risk tolerance. Experiencing significant losses early on can shake your confidence and lead to giving up on investing altogether. It's crucial to maintain a balance between stability and growth, and to set a risk level that suits you. Putting all your money into one asset. Investing all your money in a single asset is very risky. Instead, diversify your investments to reduce risk. By spreading your investments across different industries, regions, and asset types, you can manage risk and expect more stable returns over the long term. Overlooking fees and costs. The fees and costs associated with investing can have a significant impact on your returns over time. Choosing high-fee financial products can result in lower than expected returns, so it's important to compare costs and select low-cost products whenever possible. 5. Conclusion. Investing is a crucial tool for achieving financial freedom. As a beginner, the most important thing is to continuously learn and develop strategies that align with your goals. Over time, you will see your assets grow through the power of compound interest. This guide is designed to help you on your investment journey, and I hope it assists you in making informed decisions that lead to long-term wealth accumulation. Success in investing requires patience and consistency. As time goes on, it's essential to stay committed to your investment strategy and not be swayed by market volatility. Enhance your understanding of economics and finance, and develop the ability to respond swiftly to changing market conditions. Remember, investing is not about short-term gains, but about achieving long-term financial goals. Investing is your choice, and all responsibility lies with you.